Good morning, everybody. It's Thursday, September 19th, 5:26 a.m. Central Time. Grain markets are lower this morning. December corn futures down 2.5 at 410 and a quarter. November soybeans down 3 at 10.11. December Chicago wheat down 7 and a quarter at 568 and a half. December Kansas City wheat down 6 3/4 at 571 3/4. December spring wheat down 6 at 610 and a half. Let's start off with this China-Taiwan story.
China plans to suspend tariff exemptions on imported agricultural products from Taiwan. The suspensions will impact 34 commodities ranging from fruit to aquatic products. The move is not expected to have a large monetary impact. Tensions between Taipei and Beijing have been heightened since Taiwan's new president took office back in May. The new leader is pushing for Taiwan's independence, while China continues to pledge eventual rule. The tariff suspensions will take effect on September 25th. The U.S. will increase tariffs on a number of Chinese products next Friday.
Okay, so this story in a vacuum doesn't really mean anything. You're talking $7 million of affected products that were shipped across the strait last year. It's not a big deal. What concerns me is that this could be a precursor to a headline that we could see as early as next week. As Mackenzie mentioned, the United States is going to increase tariffs on a number of Chinese products next Friday. So just swap out the headline here. What if it's China plans to suspend tariff exemptions on imported ag products from the U.S.? They could very easily do that. I think if there was a year for them to do that, this would not be a terrible year. It appears as if grain and oilseed supplies within China are adequate. The Chinese government many different times has emphasized the need or desire to see the users buy domestically rather than on the export market. So they said last week when that story was reported about the September 27th tariff hikes, and I believe it was out last Friday, China said that this would backfire, and they didn't say what they're going to do, if they're going to do anything. I'm very much concerned about this. I'm concerned that China could come in and again say, you know what, we've got these tariffs on U.S. beans that we've been waiving. We're going to, again, enforce them because of what you guys have done. I think that the trade is aware that this is out there. I mean, if you're a fund manager, you are aware of this story, and you're aware that China could come in and make such a move. I hope it doesn't happen. And I know we don't like relying on China, but fact of the matter is for this year, you're not going to change the supply and demand outlook enough to not be able to rely on China. I mean, they typically account for 20% of demand for soybeans out of the U.S., maybe more than that, depending on the year. So let's hope that this is not a precursor to something we see during the coming days.
Weather in Brazil is likely to remain mostly hot and dry for another week. Far southern soybean areas will see additional rain and could become too wet. However, most central and northern soybean areas are running significant moisture deficits. The 10-day Euro model indicates very little rain through month end. The 16-day GFS, however, offers limited rain for key soybean areas. The long-term Euro EPS indicates that widespread rain will return during October. Farmers in Brazil have been slow to begin corn and soybean planting due to excessively dry conditions.
These forecasts look more and more convincing each and every day that the rains are going to return first week of October into the later part of October, if you believe these longer term forecasts, which I understand are unreliable. So I don't know how much the trade was interested in this story. I think it's part of the reason that the soybean market rallied, certainly. But if the rains return as advertised and all of this stuff is correct, they could very easily take some weather premium out of the soybean market. That's not to say that the drought story is over, because you could see some rains pop up for another couple weeks and then maybe they turn dry again. That wouldn't be normal seasonally. Seasonally, it's normal for them to kind of just shift wetter and stay there for a few months. That's what typically happens. But you remember, if you have a crop scare event in Brazil, last year it was like November. That was when beans rallied on some dryness in Brazil. So there's a lot of time for that sort of thing to happen. It just looks like this planting delay story could be on its way out if these rains decide to come back.
So if you guys have not checked out our premium content, you sure need to do so. Can you tell me about yesterday's premium video, Joe?
We had two yesterday. The first one, or actually the second one, was with Matt Bennett. Hardly any sold. Will farmer selling kill the rally? So I asked Matt what percentage of this year's corn and soybean crops he believed had been priced or marketed. And the quote that Matt had heard from people in the commercial grain industry is, farmers have hardly any sold. And that's terrifying to me, because if the crop is as big as USDA says it is, and I'm not saying it is or it isn't, I don't know, but we've got the second largest corn crop on record according to USDA, and farmers know what happened last year. They stored corn, it didn't work out. They paid a lot of money in interest, didn't work out. Paid storage, didn't work out. Rolled basis contracts, didn't work out. Is the farmer going to be more willing and apt to sell out of the field this year? It's a concern of mine, certainly. We covered a lot of other grain marketing topics yesterday. I also did a quick corn and soybean marketing update. I had some new recommendations out yesterday. And anytime I have a new recommendation, I do a video explainer where I have charts, I have spreadsheets. I show you exactly what I've done and why, and my general thoughts, kind of the game plan moving forward. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. It's a $50 per month subscription. No other fee, no other obligation. You can cancel it absolutely anytime. If you sign up this morning, I'll forward you a copy of this morning's email, which includes the new corn and soybean recommendations, all my cash grain recommendations for corn, soybeans, and wheat spread out across 3 marketing years. Yesterday's video with Matt, a whole bunch of stuff, guys. Give that deal a shot this morning.
A Ukrainian drone attack destroyed a Russian arms facility on Wednesday. The attack generated a massive explosion, leading earthquake sensors to mistake it for a small earthquake. The facility, which is located in the Tver region, was a storage site for Russian missiles, guided bombs, and artillery ammunition. It's estimated that 200 to 240 tons of high explosives were detonated. The nearby town of Toropets was evacuated, but no fatalities were reported. Also on Wednesday, Ukraine reported that Russia launched 52 drones. 46 of those were shot down. Russia also fired 3 guided air missiles, but they failed to hit their targets.
Escalation in the war and the wheat market goes wild. It didn't. We've closed lower for a couple of days now. So the rally in wheat futures has kind of stalled despite these Black Sea headlines. And you've got really 2 of them. You've got escalation in the war. You've got the West talking about using Western weapons inside of Russia. And you've also got drought. You got dry conditions and pretty excessively dry conditions in parts of southern Russia and Ukraine where they grow winter wheat, and it's being planted now. So the market has been kind of disappointing here the last few days. Hope we can find some footing here today.
U.S. ethanol production was solid last week. Weekly output of 1.05 million barrels per day was down 2.9% on the week, but up 1% versus the same week last year. Ethanol stocks were pegged at 23.8 million barrels. The print was up marginally compared to the previous week and up 12% compared to the same week last year. Implied gasoline demand was up 3.5% compared to the previous week and up 5.6% versus the same week last year. On average, over the last 4 weeks, implied U.S. gasoline demand is down slightly compared to the same period last year.
We're only 2 weeks or a couple weeks into the marketing year, but ethanol production during the first couple of weeks of the marketing year is up a few percentage points versus the same period last year. And USDA projects that corn demand via ethanol will be unchanged this year. So if we can continue this slightly stronger pace and run 2 or 3, 4% above last year, that could very easily take some bushels off of your carryout and help to tighten up the balance sheet a little bit. So this is absolutely the brightest spot when it comes to demand for corn in the United States. USDA says ethanol is going to be 36% of all demand for corn grown in the U.S. this year. So we can keep these numbers up. USDA might have to come up with that ethanol number, and it could be by a substantial amount. It could be a couple 100 million bushels, and that would go a long way. We could certainly use it.
The Federal Reserve slashed interest rates on Wednesday in an attempt to prevent an economic slowdown. The Fed cut rates by 0.5 percentage point, the first rate reduction in 4 years. The move comes as inflation is easing and the labor market is weakening. The unemployment rate has climbed to 4.2%, up from 3.7% in January. Going forward, the Fed intends to focus on strengthening the labor market and avoiding unnecessary economic damage. The Fed indicated that it plans to cut rates by an additional 0.5 percentage point this year. It's also anticipated that 4 more cuts will occur in 2025 and 2 in 2026.
So Powell made some comments. What Barron said about it was Fed's Powell isn't dovish or hawkish. He's bullish. And that was with regard to his comments about the economy. Here's a couple quotes from Powell. I don't see anything in the economy that suggests the likelihood of a recession or a downturn is elevated. You see growth at a solid rate. You see inflation coming down, and you see a labor market that is still at very solid levels. So the Fed did the half point as expected, which brings your new effective Fed fund rate down to 4.875% from 5.33 previously. And it's probably going to come down again next month. When you look at the dot plot, the expectation for the end of this year is somewhere around, 4.5, maybe slightly below that. The longer term projection is that we'll be back down to, sub 3% with the Fed fund rate. That's if you don't run into a reinflation event or something along those lines. The stock market acted kind of weird yesterday. It rallied, then it sold off, but it is absolutely on a tear this morning. The S&P is up 90 points. The Dow Jones is up 500. I think that's going to be fresh all-time highs for both of those indexes. What did cattle do yesterday?
Cattle futures were narrowly mixed. Live cattle were down 50 cents to 20 cents higher. Feeders were down 80 cents to 7 cents higher. Box beef was lower once again yesterday. Choice ended the day at 301.38. That was down 253. And Select ended the day at 289.75. That was down 247.
Outside markets, U.S. dollars about flat. Again, the stocks are sharply higher. The S&P's up 95. Dow Jones up 500. Bonds are off a little bit. Gold's up $13. Crude oil is up 57 cents in the November WTI at 70.45. Have a great day, guys. We'll talk to you on Friday.